We've got three major new accounting standards to deal with over the next couple of years. IFRS 9 for financial instruments and IFRS 15 for revenue, which will be effective in 2018, and IFRS 16, which covers lease accounting, which is effective in 2019, although it's available for early adoption. They're complex standards and they've got the potential to transform the way that companies present their performance and their financial position. They've also got complex transitional requirements that require quite a lot of forward planning. Starting with the leases standard, the common response is we know we have to capitalise operating leases. However, there isn't so much of an understanding of some of the other detailed requirements of the standards which can have an effect. For revenue, the view generally is that although the standard is longer and more complex, its overall requirements haven't really changed. And some companies say, well, our contracts are relatively straightforward anyway, so there can't be that much of a change. And for financial instruments, for companies outside the financial services sector, the view quite often is that they don't really have very much in the way of financial instruments, and so there won't be that much of an effect. Well, if I take each of them in turn, if I look at IFRS 9, while it's true that for financial institutions there's going to be the greatest effect, in fact it could change the geography of the balance sheet a bit. There's going to be a different mix of amortised costs and fair value accounting. The headline really though is that there's a new impairment model for bad debt provisions, and rather than having an incurred loss model where something has to have happened before you make a provision, we have a new forward-looking expected loss model which requires you to make predictions of the future. And that's going to be much, much more challenging because it will require to bring in macroeconomic data and other forward-looking factors. There's also new requirements for hedge accounting. This is something where it will link much more closely with existing risk management that companies tend to have in-house, and so they might want to make more use of hedge accounting in the future because it's a great deal easier than the approach that we have under IAS 39 at the moment. Going to IFRS 15, it's a new model and it's a subtly different new model. And what that means is that it looks the same on the surface, but then when you start digging into the detail, you find that the differences are there. It's a much longer and much more detailed standard than we've had to deal with before, and typically we're finding that people are getting surprises when they start looking at what the standard actually requires. And then for leases, it's true, as I said, the headline is everything comes on balance sheet. What that does is gross up assets and liabilities. It also changes the income statement. So if you focus on EBITDA, for example, you'll have increased profitability because an operating expense under existing GAAP will become depreciation and an interest expense under IFRS 16. What's not so well known is that because we are dropping the difference between an operating lease and a finance lease, all the pressure now goes on to whether there's a lease at all. The result of that is that in some service contracts where the service depends on the use of an asset, we're sometimes finding that what people are thinking are just executory service contracts which are kept off balance sheet, in fact have leases of assets which are coming on balance sheet. So all three of these standards have got complex and in some places difficult transitional arrangements. There are many options and reliefs available to ease transition and make it easier to get onto these new standards. So decisions need to be made. A really key date is the date of initial application. That is the first day of the accounting period in which you adopt the standard, so the current year, unusually, so we're not looking at the start of the comparative period. And that's the date on which you make the elections for which reliefs you're going to take and which options you're going to take as well. So it's something which can affect financial statements for some years, not just in transition, but on future years after that. So this needs to be quite high up the agenda when you're looking at your transitional project. From a securities regulator perspective, it's a little bit patchy. We're seeing some who are very active, others less so. Where we're seeing the activity is in Europe, North America and Australia, for example, and there's a great deal of interest being taken. Part of this links into disclosures that are required to be made under IFRS on the way up to the adoption of standards, where in prior years there's a requirement to give an indication of where you are in your transition project and the likely effects of the adoption of the new standard. The securities regulators have indicated that they would expect to see in 31 December 2016 year-end financial statements some indication of where companies are with their projects. Not necessarily numbers, but they have also said that in the 30th of June interims, or in some cases year-end financial statements depending on jurisdiction, they would be looking for a quantitative effect, so an estimate of the likely effect of these new standards on the numbers. The important thing about these projects is that because of the very wide-ranging potential effect they've got, it's not just something to give to the finance department. It's something that needs to involve a wide range of different people within an organisation, including sales and marketing. It's also important that you've got someone who's senior enough in the organisation to run the project and take responsibility for it. That person also needs to have access to people who have necessary detailed knowledge of the standards. This is a very key point as we run into this final year before the date of application, because the pool of people who really do know about these standards is relatively limited, and there's going to be a lot of demand for them. And we're already seeing pressures in the financial sector for IFRS 9, where there's a real scarcity of resource. Depending on the size of your organisation, it might be appropriate to set up a steering committee so that you've got something which oversees the overall project and can report into the board. The board's got to be bought into the project because there has to be enough support for it, and the audit committee needs to be briefed as well. And because the concepts in these standards are relatively new and have some new outputs from them, it's necessary to make sure that the board and the audit committee understand what the potential effects are. They need to know what the pitfalls are, they need to know the headlines, so that when they get reports back of how the project's going, they can ask appropriate, difficult questions and keep the whole project on track. Starting with a more positive note, if you do plan properly for this project and put adequate resources into it, the chances are it's going to run smoothly and you'll have a good transition onto the new standards. The risk of not doing that is that the project will run late and the numbers either won't be ready at all or they'll be ready late. In terms of what the markets then see, they either see something that surprises them, you might even have to issue a profit warning, and that goes into a loss of investor confidence. It could result in reductions in share prices. On a wider basis, there are knock-on effects as well. There are lots of earnings arrangements for management and staff that are linked to the profitability of a company. These could change. And also from business combinations, many of these have some sort of earn-out or contingent consideration, which is based in future profitability or earnings of an acquired entity. And if you get that wrong, you could potentially overpay significantly for something that you've acquired in the past. The key message is it's not too late, but it's almost too late. And so it really is time to get started at this point. I could be flippant and say tomorrow morning is a good time, but certainly in the very near future. Otherwise, you're not going to be able to find the right skilled resource and you're not going to have time.